All right, excellent. Well, thank you for that warm introduction, Raleigh. Thanks for to the Trading Pub for having me. Can everybody hear me okay? Just want to make sure the sound is still as it was. And as Raleigh said, you should also see the slide that I've got up there in the application sharing. All right, excellent. Well, all right, then we're ready to go. I don't want to waste any time here. We want to get through a good amount of information, and I'd like to also bring up some charts as well to talk about some stuff. Yeah, Shimo, we're definitely going to talk about trading in general, and one of the nice things about the Pristine method is that no matter what I'm talking about to you here today, you can apply this information to whatever your style is, and that, like I said, is one of the great things about the Pristine method, in that once you learn it, the concepts are universal. So in other words, I'll talk to you a little later on in the presentation about my favorite pattern, which can be implemented on monthly charts, weekly, daily, 60, 15, 5, 1 minute, whatever. So just know that regardless of the time frame that we're necessarily looking at in some of the examples, the same thing can be applied to whatever your personal time frame is. But a more direct answer to your question is yes, we will talk about day trading and some of the necessities that one wants to make sure they have for their own trading. All right, so before I really get into anything, Raleigh's already kind of touched on it, but our founder and president, CEO of Pristine is Greg Capra. He's, won multiple live trading challenges. He's authored multiple books. Just very well known within the industry. And as Raleigh also alluded to, I am his son. I've been with Pristine for many years now, 7 of which I've really been more involved in the education aspect. And of course, I'm a trader myself as well. I currently am involved in many of the trading rooms. You can see me logged into all those. As I said, I teach multiple courses here at Pristine, ranging from our, one of the first courses that we've ever offered, Trading the Pristine Method, all the way up into our more recent offerings, such as the Forex prop program. And in keeping with that thought here, we have a free webinar later today that Greg Capra is going to be doing. He's going to be going over charts that you yourself, if you choose to attend, can ask him to review. He'd be happy to do it. He'll be reviewing the current market environment, where he sees it going. He'll look at many intermarket analysis type tools. What's gold been doing? Obviously, it's gotten hammered pretty good here over the last several weeks and months. He'll look at some market internals, end of day market internals, which are also extremely useful in putting together a plan for what one might be expecting out of the market in the coming days, weeks, months. So if anybody's interested in attending that or registering for it later today, you can do so through that link right there. Yana also posted that there for me. Thank you very much. So that's, like I said, if you have time later, then you're more than welcome to join us, okay? Before we start getting into any real concepts here, just, as everybody has to do, standard disclaimer here. Obviously, guys, it's possible to lose money. If you don't know that yet, and as it pertains to trading, you will learn it. If there's anything I can guarantee to you today, it is that you will lose money trading. That's just part of the game. That's part of any business that you get involved with. However, the key is to keep your losses small while maximizing your reward. Now, of course, easier said than done, but one of the ways that you can achieve that is through a proper education. And of course, we all thank Trading Pub for putting together an event like this, where you can have multiple speakers coming and talking to you about their educational offerings, and then you have to decide for yourself which one resonates with you the most, which one makes the most sense to you. One of the things that I don't recommend is that you try to get a little bit of something from everyone, or you know, of course you may pick up a nugget of information here and there while we're all talking, but when it comes to where you ultimately will call home for your education, I don't suggest choosing multiple sources, because that can get confusing. Inevitably, there will be some issues or concepts which conflict with one another. And that could actually be even more damaging to your overall approach to the market than anything else. You know, there is no perfect indicator. There is no perfect methodology. You have to accept the flaws in everything that there is in life. But ultimately, you just got to decide which one it is that makes most sense for you, and then just commit to it. Bouncing around from one place to another is one of the worst things that you can do for yourself. So just keep that in mind. Right? That's all I'm going to say as far as risk and education. Okay. Now, some of the speakers have already talked about the need for psychology and for a plan, but I want to expand on it a little more, and we will look at plenty of chart examples, but this is one of those things that a lot of people don't talk about, and it can be a somewhat mundane, somewhat boring, but if you really want to be a successful trader, this is one of the very first things that you have to have. If you don't have a plan, then basically, you know, as the saying goes, if you fail to plan, you plan to fail. It's that simple. And I mean, it's the same thing. Look, trading is a business, just as anything else. If you go into business and you decide to open up a restaurant and you have no business plan as to how you're going to be successful, you're not going to be successful. So you have to have a plan. That being said, it may be difficult at first to really nail down exactly how you want the plan to look. So we provide different options, different things for you to consider, such as what we're going to talk about here. Right? So in other words, what should it include? Goals. You have to have goals. And I don't mean, you know, daily goals, and I don't mean necessarily yearly goals. You have to have everything in between as well. Because if you say, oh, you know, I want to make X amount of money in a year from now, that's fine. I encourage you to have aspirations for a year out. But how are you going to get there? How are you going to be able to measure those results, say in a quarter or even in a month, right? How are you going to know if you're on track? How are you going to know what adjustments must be made in order to achieve that goal? One of the things I don't suggest doing is having a daily goal. I am not a big fan of daily goals as far as, you know, profit targets. Of course, you have to have an amount you're willing to lose per day and per week and per month, but I don't like daily goals. The reason I do not like daily goals, well, instead of it, you know, saying straight out, let me ask you a question. Let's say that you have a daily goal of $1,000. Right? You want to make $1,000 a day. Now here it comes, 3 o'clock, 3:30, and you're up, say, $750. What are you likely going to do, right? It's 3:30, you're up 750, your goal is 1,000. What are you likely to do? And you know, again, this is just human nature a lot of the time. What is someone in that situation likely going to do? Right, they're going to overtrade. They may get into bad trades because they're trying to achieve that goal. Exactly. And it's going to end up probably losing you money in the end, right? As JD said, it's human nature to go for the goal. And that's part of the flaw in having a daily goal, is it's going to cause you to go for that goal, and as a result, instead of being up 750, you might be only up 400, or even worse yet, lose it all, or worst case scenario, go negative. because, now you're up 750, then you place a bad trade, you're down a little more, now you want to be back to 750, then you lose some more, and it just spirals out of control. And it's for that reason that I do not like daily goals, because in a subconscious sense, if we don't achieve that daily goal, we almost look at it as if we failed. And I don't like that, right? If you're up 750, did you really fail when you know other people have lost money on the day? No. So I am much more drawn to weekly goals, monthly goals, things like that, where you can have a larger kind of grouping of trades to measure it from. Because look, let's take it even a step further. Let's not even just say, you're up a certain amount. What about the market recently, right? The Qs have mostly been going sideways. A lot of, last week into this week, there's been a good amount of sideways action. Sometimes the market environment on a day-to-day basis is simply not set up well for good follow-through and good movement, right? So why do I necessarily want to enforce such strict rules and guidelines on myself when the environment really isn't there to have the kind of quality setups that I want? So by not having a daily goal, you're able to say, look, I don't have to make it all today. I can make it tomorrow, because maybe tomorrow is going to be trending really, really well. And I'm going to be able to not only make 1,000, but maybe make 2,000 or more. So I'll make up for it because the quality of the environment is there. So that's enough on that one. As far as what tactics are you going to trade, what setups are you going to trade, right? You have to determine that for yourself. Now, as I said, it may take a little trial and error. You'll have to kind of feel your way through different patterns, different strategies. So it would be prudent to paper trade in the beginning, or, I understand that a lot of traders don't like paper trading. You can't feel the true emotion in it. I get that. So trade small shares. Don't be trading, a full lot size just as you're trying to figure out if this strategy is one that you want to make part of your daily plan. So trade it with smaller shares. So at least this way, you do have money on the line. You can feel that emotion, but it's not going to break the bank. And how are you going to manage your trades, right? Pristine talks about 4 different stages that any stock market, Forex pair, whatever you're trading can be in. It's either going to be going sideways in what we call either a stage 1 or a stage 3, or it's going to be trending up or trending down. So you have basically 2 different sideways trends, and then either an uptrend or a downtrend. So that gives you 4 different stages. Now, obviously, if markets are trending up or trending down, you may want to consider holding on using pivots, because you know that the potential for a larger move exists. Whereas in a sideways market, you want to be playing the range, the top and the bottom. I mean, the Qs would have been a perfect example on the 60-minute chart up until, the other day. You could have been just scalping the top and the bottom of the range, and that could have been it. That one thing alone could have been making you a nice bit of money. The point is, you have to have different management rules given different conditions. If you're trying to hold on for a big move in a sideways environment, good luck. You're going to give it back. So have you considered that? Right? What are going to be your daily habits for the day? Are you taking periodic breaks? Are you staying hydrated? Right? Staying hydrated is extremely important. If you're not hydrated, you can actually end up making poor decisions by not being hydrated. Let me just catch this question here. How do you know that the range environment, for example, stays in that environment versus trending? Well, that's a great question. One of the things that we look for would be the larger time frame to give us an indication as to what the overall trend looks like based on the bigger picture. Because ultimately, we will break one way or the other from the range. And so that would be one of the things to wait for, right? As you're playing the top and the bottom of the range, you're ultimately going to get stopped out at some point because eventually, like I said, it will break out or break down. That is just a cost of doing business, right? That is, in a sense, you're paying for information almost is how you might want to look at it. Right? It's been moving up and down in this range. You take it again, you take the trade again, and it stops you out. Well, instead of saying, you know what, damn it, I got stopped out, that really sucks, say, hey, things are changing. This exact trade worked for me 3 or 4 times in the past. It's not working this time. That's suggesting this is getting ready to make a new move or establish a new trend. The other thing that I can offer you as far as an answer to that question is to look at how the ranges are behaving. For example, not yesterday, but the day before, the Qs moved up to the top of the range and they started to go sideways as opposed to just immediately reacting back to the downside as they had done in the past. A subtle little change like that was very telling about the breakout that the Qs were going to experience yesterday. So those are some of the things that you also want to look at, is just the bar by bar interaction. How do you know when a sideways market starts? Well, generally speaking, when you have at least 2 relatively equal pivot highs and pivot lows is when you're getting into that range-bound environment. There are some other things that we do look for, such as how candles are setting up. But like I said, generally speaking, if you have 2 relatively equal highs or equal lows, you're probably getting into a more range-bound environment potentially. And as I said before, you also look to the larger time frame, because if it is overbought or oversold, it is more likely that you will see a sideways environment set up. Okay, so like I said, consider those things. Stay hydrated. Take breaks. If you have a bad trade, don't sit there and watch how it unfolds afterwards. Get up, walk away. Make sure you have other habits that you do. Do you exercise during the day or when you wake up or at the end of the day? Whatever it may be. Yeah, scream. No, I don't have any charts up right now, Z. I'm just the slideshow at this moment. We'll look at some charts here in just a little bit. And then also make sure that as part of your plan, you're tracking your stats, your batting average and your Sharpe ratio. Batting average tells you how much more often you're winning versus losing. Your Sharpe ratio tells you how much larger your winning trades are versus your losing trades. Okay? So consider that as well, because that's going to tell you a lot about who you are as a trader and where you may need to improve or maybe not necessarily improve, but just embrace this as who you are. And as an example, let's say you're a scalper. You're going to have a high batting average and a low Sharpe ratio. Let's say that as a scalper, you have a 70% batting average. Not bad. But as a scalper, you want to be much better than that. If that's just who you are, you need to focus on getting better quality setups. You need to get that batting average up to 75, 80%. That should be the focus. So like I said, by doing this kind of statistical analysis, you will better understand who you are and where you need to improve, because, hey, let's face it, you may be struggling, but not knowing where you're struggling. This kind of information will tell you. Maybe you have a high batting average but a low Sharpe ratio. That tells you that you need to work on your management. Maybe you need to consider your management in the whole process of planning out the trade. Right? So those are some things to consider. Now, as far as discipline goes, it's extremely important to stay disciplined. Once you decide that, hey, this is going to be my plan, you have to stick with it for a little while and track the results and determine, if you're unhappy with those results, when are you going to adjust them? If you have 1 or 2 bad trades that go off, you can't just start saying, oh, I'm not going to take this trade anymore, or I'm not going to use this strategy. That's not enough sample size. If you are starting to question it, like I said, trade smaller shares or paper trade it until you have enough information to either say, yes, this is something I'm going to keep, or no, it's not. You should also have three different folders, a red, a green, and a blue. The red ones are for trades that don't work out. The green one is for trades that do work out, and the blue is for trades that you didn't take but you wanted to. The reason you want to organize it in this way is because, hey, if you keep all your losing trades together, you're going to be able to find out the common denominator as far as what is causing you to get stopped out in certain situations. And let me tell you right now, your future winners are locked inside of your current losses. If you can determine what that common mistake is that you continue to make, because I promise you that it is probably the same mistake that continuously is being made and causing you to get stopped out. If you can unlock that answer, you can start to just kill it. So make sure you're staying organized in this way. Make sure that you're learning from your mistakes, right? Sometimes trades don't work out. Maybe it just didn't work out because, hey, not all of them are, but maybe you made a mistake. Maybe you didn't follow your plan. Maybe you mismanaged it. Are you learning from those mistakes? If not, you're going to keep making the same error over and over, and you can't blame anyone else but yourself. You have to take trades that are only in your plan. Like I already said, how are you going to handle if you have a bad trade? Don't keep looking at that stock because it can get frustrating, right? And make sure you have max loss rules in place. You don't want to blow up the account, and make sure you've got someone to keep you accountable as well. So those are all things to consider as far as a plan goes. Right? Because the last thing we want to do is end up in a situation where we're placing a revenge trade. You know, a trade goes off, we place it, we get stopped out on a wiggle or for whatever the reason may be. We've all been there, right? We've all been there. We see the trade turning after we've gotten out. No, this is Kurt Capra. So we are in the trade. It ends up stopping us out on a wiggle. We all know the feeling. We start to get pissed off. We want to get back in it, whatever the case may be. And what generally happens, right? When you place a revenge trade, what generally happens? Because again, we've all been there, right? The loss, it becomes more, and then we get more frustrated, and our emotions start to take over. Exactly, it starts to spiral. So you have to make sure that you are not allowing yourself to fall into that situation. Of course, easier said than done, but you have to make sure that you're putting yourself in a positive state of mind. That's why, like I said, if you have a bad trade, whether it was from mismanagement or it just didn't work out, don't continue looking at that stock or whatever it is you're trading. Take it off your screen, start scanning for other opportunities, or just walk away and take a break. Don't stay there. All right, guys, now something else I want to talk about, indicators. You know, a lot of people talk about the need for indicators. We've got a list of them here: MACD, trend line, Elliott wave, Andrews pitchfork, Fib retracement, stochastic, Bollinger Band, you know, etc. Let me ask you, what is the percentage of traders that fail? We all, you know, we've all heard it, the statistic thrown around. What is it? What is the percentage of traders that fail? Yeah, 90, 95%, right? So it's high, right? Obviously. Let me ask you a follow-up. What percentage of traders use indicators? Now I'm just going to put a little dash here, right? What percentage of traders use indicators roughly? This one probably a little more difficult to pinpoint, but yeah, right? 90+%. So let me think about this for a minute. 90 to 95% of traders fail, and 90 to 95% of traders also are using indicators. So if indicators worked, why would 90 to 95% of traders be failing? Shouldn't that relationship be inverted? Right? If indicators were magical, if there was some great combination of indicators, wouldn't a large majority be successful? Well, that's true, yes. They are lagging indicators, and that's part of why traders fall into this trap. Right? So what I'm getting at here, guys, is Pristine, we do not use indicators, right? We do, you'll see some, moving averages on my charts, but that's it. And I'm not even using the moving average in a way that is giving me a buy signal or a sell signal. And I know that there are other people who have spoken here today so far and who will continue to speak. And I'm not trying to talk down to what they're doing. It's just been our experience that price is king. And I can give you examples of any chart where you might want to say, oh, well, they showed me this chart where, the Bollinger Band or the RSI or the Fib retracement lined up perfectly and it worked out so well. I can show you the same exact chart, free of any indicators, where it was probably in alignment with some level of price support or resistance. It was in an uptrend and just at a key level where it had created support. That's all you need. An understanding of multiple time frames and support and resistance. Those are two of the biggest things. So I'll show you exactly that. Now, here we've got a stochastic and a CCI. Right? Now, and before I even start analyzing this chart, guys, we have to understand that the terms overbought and oversold are subjective. Does everyone know what subjective means? And again, I'm not trying to, speak down to anyone here or ask a stupid question. I just want to make sure that we're all on the same page as far as what that term means, right? Subjective meaning it's open to interpretation. Exactly. It's only someone's point of view. So when I say to you something is overbought or oversold, that's my opinion. It doesn't mean that it can't become more overbought. I mean, shoot, look at the Qs, right? Look at the Qs. People would have said that the Qs were overbought way before, they started to consolidate. So we have to understand that even having an indicator on our chart to suggest something is overbought or oversold is just someone's point of view. And as you look at this chart here, you can see that these overbought readings, while yeah, maybe they resulted in a stall, they would not have made you very much money, if any at all, because this is all within the context of an uptrend. So if you're going to say that something is overbought and then look to sell it short, well, first of all, in this case, you'd be going against the trend. Secondly, have you considered what the larger time frame looks like? Yeah, especially after a gap. Exactly. Over here is a perfect example, right? Here's the gap up after price pulled back by no coincidence into support. It pulled back, gaps higher, and this shoots right up to overbought. But does that mean it's done going higher? Obviously not. And then, so traders will start to add in other indicators, maybe a CCI, maybe a Bollinger Band or Fib retracement levels they're going to start looking at, and Fib extensions. And before you know it, the chart is so small you can't even see the candles. You've got so many other indicators where you're trying to come to a decision, and that gets confusing. These indicators become a crutch that traders feel they need to lean on for some kind of support. CCI, not CTI, I'm sorry. If I said CTI, I meant CCI. Right? It's the commodity channel index down here. Right? Yeah, Fib retracements, they do try to forecast where price is going to go, but at the end of the day, if you understand support and resistance, you honestly don't even necessarily need Fib retracements. So again, you don't necessarily need indicators. And what are traders going to do? I mean, let's say that these indicators aren't working given the current environment. They'll monkey with the settings to try and get the desired results. And then what about the next day after that when momentum or volatility increases or decreases? Now you're going to have to adjust those settings once again to find the perfect ones that fit the current environment. And it's just a revolving door. Right? Everybody, well, I shouldn't say everybody, but you know the movie Elf with Will Ferrell? You know that scene where he's at the Empire State Building or wherever it is, and he's just running in circles in that revolving door? Anybody remember that scene in that movie Elf? Yeah. That's kind of the path that indicators will lead you down. You'll get stuck in that revolving door without any real clear direction. Now, like I said, they'll start monkeying with the settings. These tools ultimately are misleading and lead to confusion. Here you can see now that we've changed the stochastic, it stays overbought, but yet this is able to continue moving higher. So there's more to it than just simply a need for indicators. And the same thing can be said with trend lines. You know, trend lines, they can be a useful tool, but the generally accepted manner in which they are used makes them misleading or gray area, if anything else. You know, how are you going to draw the correct trend line? And what time frames are you going to base these decisions off of? Here you've got 3 different trend lines drawn on your chart. Once a trend line is broken, the general way in which traders think is that the trend line has been broken. I'm going to look to sell short, in this case, a retracement back up into that trend line for a move lower. And as you can see, each time there was a break of this trend line here, these first 2 examples, there was a reaction back up into the trend line, but it was short-lived. And the trend just started to go sideways. Why? Because, look, we came down to support. You see this black line? We came down to support. When you're analyzing supply and demand, it should be done horizontally, not diagonally. So it's extremely important that you understand key levels of supply and demand, because a trend line can be violated, but yet the trend remains up. Case in point, right here. This is a perfect example of that. As you can see, it pushes up. Now we get this very sharp move down, which again breaks this trend line. This is a more significant event because it's breaking under support, and the speed at which this retraced, along with the failed attempts to move higher from these green candles. All of this information is a strong message suggesting that we're going to move lower. But let's just say that traders had tried shorting this 2 other times in the past, and they got burned. Are you going to be so willing to take it short a 3rd time? I don't know. Maybe, maybe not, right? It depends. You're certainly going to see that it looks like it's going to drop, but are you going to have, you know, a hesitation here? Probably. If you got burned 2 other times on the same chart, probably. So the bottom line, again, like I said, is that there is not a need for indicators to make trading decisions. All you need is price. I mean, all you need is price. So let me show you. Let me show you what I mean. Here you don't even see anything other than price and volume. There's not even a moving average here. Here's HD, right? This is the daily chart. It was gapping up on this day. It's gapping up above this base in an uptrend, so we want to be looking to play it long. 5-minute chart, right? So we're taking the bias from the daily, drilling down to the 5-minute chart. Now, everything we've talked about thus far is really how you should not be using charts, or, you know, the mistakes that, in my opinion, many traders are making. What I'm going to show you now is how you can make decisions in a clear, concise manner without having to hang your hat on needing anything, you know, getting rid of the crutches, getting rid of the indicators, walking on your own. So here the 5-minute chart, nice strength at the open, it moves higher, consolidates here briefly, nice little base setting up, you buy the breakout and manage it bar by bar on half or the entire position. But here you have strength at the open with a nice strong gap up on the daily. You buy the breakout, and here you manage it bar by bar, and you make over 2 Rs on this trade. 2 Rs meaning 2 times your risk. So if you were risking $1,000, you made over $2,000. And that's just on this one trade alone. It doesn't take many of these to be a successful trader. So boom, there it goes. All right, this breakout really doesn't amount to much, but you should not be really looking to play this breakout because, first of all, you had to run higher in the morning. Second of all, it's in the dead of the doldrums. Odds are not so likely that this is going to make a strong move at that point. Okay? So focus on the good quality trading times as well. Again, we're able to make a decision. We don't have an RSI, a fib retracement, MACD, none of that. It doesn't matter. Reading supply and demand and understanding human emotion, that is what you need to make trading decisions. And then, of course, you know, we could start getting into a whole conversation about entries and exits, and that could probably take up the remainder of my time here. But, you know, you have to find a pattern, not just identify a certain level, right? You can identify a support level, a resistance level, but you also have to understand where you should be getting in. What are the signals that you should be taking, right? Why is it that we would buy a breakout? You know, anybody knows how to buy a breakout. You buy it over the range. But why? Why would you want to buy it over the range? What, in other words, what is significant about breaking above the range? Does anybody, you know, anybody have any idea from a psychological aspect? Well, yeah, you do have, there are going to be stops above the range for those who are trying to trade in it. Right, you've got no resistance above. It's into clear air. By breaking above the top of the range, you're essentially saying that I'm going to buy this when it breaks out above resistance and into what we call a price void. So that's the psychological component of it. It's breaking above a resistance area that has proven to be a difficult level to get through in the past. Once traders have seen that area and identified it, when they see it being violated to the upside, they're all going to start to look at piling in, especially when you've got a daily chart that looks like this, right? So it's a combination of larger time frame, smaller time frame. Let me show you another example. Here, Euro Aussie dollar. Doesn't matter what you're trading. Like I said, doesn't matter the time frame you're trading, what you're trading. Here, Euro Aussie dollar breaks down. Right? Retraces into a congestion area. You get what we refer to as a bearish changing of the guard, momentum slowing down here. Again, you don't see anything on this. You don't see moving average. You don't see fib retracements or any of that stuff, you know, Bollinger Bands. They're not necessary. You don't need them. You need an understanding of trend analysis along with multiple time frames, support and resistance. That's it. Here you have over a 70-point play, and you just simply sell it short below this low here, and again, manage it bar by bar. Don't you need support and resistance lines? Well, I mean, if you want to draw them on your chart, Dev, you can. But if I wanted to, and not that we have a whole bunch of information here to see to the left, but if I wanted, right, I could just draw a support line right there. I got to straighten that out. But I could just, you get the idea. And I could just draw a support line right there. Now, that being said, if you're in a downtrend, let me ask it as a question. If you're in a downtrend, should support be violated? Yes or no? Right? If you're in a downtrend, should support be violated? Bill, the time, if I'm trading equities, I like the 5 and 15-minute charts. If I'm trading Forex, though, I like the hourly and 4-hour charts. Yeah, absolutely, right? Support should be violated. So, oftentimes, and this is something that I try to teach our traders not to do, if we were to short it up here, right? Let's say we took an entry right under this narrow range bar here, or narrow bodied bar. Many times traders are going to put their target right down here at this prior low, right? Isn't that true? Traders will put their target at the prior low if they shorted a retracement, right? But why? You guys just told me that support should be violated if you're trading in a downtrend, right? So it's kind of like, well, you told me that support should be violated, but yet targets are going to be placed down here? That doesn't make sense. Yes, you should expect a reaction here, right? You should expect a reaction, and the fact that, right, the fact that you got this bottoming tail that's set up right there tells me that there was a reaction, but that's to be expected. You should still look for further downside. So as Trudy said, right, manage bar by bar, put a stop above the prior bar's high. That should protect you from any wild swing. Bar by bar analysis, right? If you're tracking bar by bar, you get stopped out on this pop higher. So you get in over here, you get this entire drop. You should expect prior lows to be taken out, assuming you're trading in a downtrend, and prior highs to be taken out, assuming you're in an uptrend. Now, as I said earlier, right, if you were trading in a sideways range, you should expect this support level to hold, as it did over here, right? In this little mini range, you see the lows holding and the highs holding. That's what you should expect until we get a break one way or the other. But once you're in a downtrend or an uptrend, prior highs or prior lows should be traded through. Well, it depends on, again, what time frame you're looking at. As far as your question goes, Frank, should be able to short the current environment. It depends on what time frame you're looking at, and then also you have to consider the larger time frame to make sure that you're not trading against it, because let's say the 5 minutes in a downtrend, but the 15 is simply retracing in an uptrend, odds are against that short position. If you were to trade in a trading range, you're basically just trying to pick off the top and the bottom. So you'd bid for it down here. Once you see stabilization, you'd offer out up here looking to get short and just play the range. Now, again, you have to put that in the context of the larger time frame as well, and make sure that the range is a tradable one, and all that stuff we talk about, in detail within our courses. Here's another example on BITA, B-I-T-A. Keep it simple, right? Here's a pullback. So instead of looking at a breakout, now we're talking about a pullback after a gap up into support and the rising 20 MA. Here we've introduced a moving average. Not that you need it, but it's there now for you as an additional amplifier. So you could buy it over these highs or buy it over the green candle. Either way, make sure you're taking this, getting on board. Nice, easy move. I mean, look at this. Does it take out a prior bar's low? Where? No, 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 no. All the way up until here. So you're talking about entering down around, round number sake, we'll say 83. You would have gotten taken out up just under 89. Beautiful move. Right? And here, right, here's a pullback during the doldrums. Where does it pull back to? I don't need a fib retracement or anything. It pulls back into this area of support. I don't need anything to tell me where support is other than the chart itself. It's a 20 simple period moving average, Dev. And no, Bill, the candles, that's all you need. Just candlesticks. You don't need range bars, volume bars. But again, pulls back to support, and then it begins to move higher into the afternoon where it likely would have continued to move on up. We just don't have enough information to see it. But again, I don't need to know there's a fib retracement here. In fact, depending on where you're measuring that fib level from, I mean, if you were to use the fib level from down here all the way up to the high, I mean, it may or may not be at that 38.2% retracement level. Yeah, I agree. For Forex, I like the 4-hour chart. I like it a lot. Here's another example, INCY. Gaps up above this range, wide range bar to start the day, little consolidation, right? So you can see the different patterns I've shown you, whether you realize it or not. We've looked at breakouts, we've looked at pullbacks and retracements. Here's a continuation pattern that we teach, all of which have different amplifiers to where we teach a point system to enhance the success of a trade. So you've got options, you've got different ways to get on board setups, because let's face it, sometimes setups don't pull back, or sometimes stocks won't pull back. Sometimes they won't base long enough, but they set up continuations like this. And here again, you get a nice over 2-hour trade in just a matter of a short period of time. Yeah, engulfing candles at the 20 MA, those could be very powerful signals as well. Absolutely, we certainly look at that as well. And as Yana posted there, guys, we have an open house to our trading room. You want to see, these kinds of setups played real time. If you click on that link, you can register for our open house on Monday and Tuesday of this coming week, and you can get in the room and see it, in action. In addition, we also have 7 steps to a good trade, which we're offering to those of you guys who are here in this event. It's only for Trading Pub people, so if you want to also have access for free to that, you can simply click on that link, which Yana just posted as well. And, again, on your own time, you can download that. And it's yours. There you go. You have it. It retails for $149, but no charge for you guys here today as our gift to you and our way of saying thank you for being here. All right. Now I want to just show you my favorite pattern before I start wrapping things up here. This is my personal, bread and butter go-to pattern. And this is a slide right out of our manual that we teach our traders. We call this a Pristine Buy setup, and it's key to capturing robust 3 to 5 bar gains, and really can be even more than that, because the 3 to 5 bars, that's a general rule, but what I do is use bar by bar to manage positions a large majority of the time. And so sometimes it'll be more than 5 bars in my favor. Sometimes it may be 6, 7, 8, 9 or more until I'm getting out of a position. So I will let the trade, just do what it's going to do. I will let it do the work. I'm going to, my job is to enter good quality trades. Once I've done that, it becomes the market's job, or the stock, whatever I'm trading, it becomes its job to take care of the rest. And I just have to manage it in between. I'm not trying to get myself, too involved with it. I'm going to manage bar by bar. It's very simple. Once a prior bar's low is taken out, I have to exit the trade. Those are my rules. That's what I have to adhere to. It's very simple. There is no confusing part about what I just said. Now, the PBS, it receives 20 points in our scoring system. And it can be found and traded in all time frames. Now, like I said to you before, some of those patterns we were looking at were 70 points and more, because we talk about additional amplifiers that make the trade setups better quality. Here, this is a Forex pair, and again, you can see here, look at this beautiful uptrend. Look at this beautiful uptrend. Here we have a strong move up above the moving average. Pullback, you buy it. Moves up, pullback, you buy it. Now, again, all I have are moving averages here. No fib retracements, no MACD, RSI, Bollinger Bands. I don't need them. I just need an understanding of price action and movement. Look, the bottom line is this. Price pulls back, right? Let me just show you. Price pulls back here, right? Into support. It crosses below this moving average, but that really doesn't matter to me because a moving average is just a guide. So it pulls back into this support area. That's the key. That's where buyers are going to step up. Now that I know we're into support, I'm not just going to buy it here. While you could have done that and it would have worked out, that's not necessarily what we teach, right? We teach you how to do that should you want to, but that's not the main focus of what we're talking about here. You've identified that this is pulled back to an area of support. Now I'm waiting for the signal to support that. You get a red bar down, followed by a green candle right back to the upside. That message, that two-bar combination, that's the signal to say buyers have stepped up. They're defending this area, and now I can look to take a long position above these highs. These moving averages, for Forex, it's a little different than equities. For Forex, I like to use the 8 and 21-day exponential moving average. But again, you know, at the end of the day, moving averages are just a visual tool to help speed up the analysis. I'm not necessarily taking a position because of the moving average. Now again, beautiful move up. Price pulls back again on top of support. You buy it down here. This one chops around a little bit, but ultimately it holds support. Your stop would have been under this area. It holds it and moves up perfectly. And now it starts to consolidate in a sideways range. We'll see where it goes. The uptrend is still intact. My overall bias is still bullish. I would not be shorting a breakdown if it were to occur in this situation. Why? Because how much room does this have? How much room does this have to drop? First of all, it's in an uptrend. Second of all, you've got support right down here. There's no real room. Now, and that's assuming that it's going to fall all the way back down to this support. Oftentimes what you'll find is that traders will start bidding for price above a support level. So it may even just try and hold up here. So there's again, no real room for this to move in the way that I want it to. Here, this is a smaller time frame, and again, you can see it doesn't matter. Price is in an uptrend. Here's a little pullback. Here's a little pullback. Here's another PBS. Now, you might say, well, wow, this pullback drops below the 8 and 21-day moving average, but what does it drop into? Surprising, right? It drops into support. Is that a shock? No, it shouldn't be, not after everything we've been talking about. It drops down into support, and look at this two-bar combination. Look at this two-bar combination here. Traders, let me ask you, were traders shorting this breakdown, yes or no? Were traders going to be shorting that breakdown? Of course they were. Of course they were. But then it reverses right back up. Traders that were shorting got trapped. What happens after the breakout to the upside? It pulls back. Beautiful PBS to play right there. Right? Beautiful PBS and easy move higher. Right? Same thing here. Right? Same thing here. Beautiful pullback after this first one failed. Now this first one fails, as it says here, not every trade is going to work out, but not for nothing. This wasn't the best one to be taking anyway. And one of the reasons for that is because of the way in which it came down. This big red candle was the first signal that said, hey, this PBS is lower odds. So we will prepare you to understand when to be looking to take a position and when not. It's not to say every pullback is buyable. Right? That's why we have the point system to rate the trades. This one is a much better opportunity, as you can see, works out. This one, again, a nice opportunity into support. So, guys, as Yana said, we also have an open house to our trading room this Monday and Tuesday. You can get in there, no charge, free access. Hopefully, we will see you there. But what I'm going to do here now, guys, is bring up some live charts, Forex charts, and show you some of the stuff that's been going on here recently. So that concludes the presentation aspect. But like I said, let me bring up some charts here to show you. Just take me a moment. And if it's too big, you can resize it to fit your screen, or you know, just adjust it on your own end, because I still have some time here. Can everybody see the charts? We've got 6 different charts right now. Just want to make sure everybody can see them. All right, awesome. Like I said, you can't see them. They're kind of small. Let me resize them. I'm gonna bring up 4 charts instead. I can always just pull up different windows. So let me just resize this here, make it a little easier for people to see and not have to squint. All right, so that should be easier for you guys to see. Yeah, I agree. You know, live trading, you can't beat it, but you know, given the time of day right now, it's real slow. As far as Forex goes, things are slowing down, and so I wanted to definitely provide value, and one of the ways we can do that is through looking at prior examples, but also, like I said, getting into the open house, and you can see it done real time for 2 days straight. You know, this is not just a little snippet, but for 2 days straight, and then you can decide for yourself whether it's the real deal or not. Okay, so you can see these 4 different charts. We've got Euro, US dollar, Aussie dollar, New Zealand dollar, pound dollar. And, you know, the pound dollar has wide range bar moving down. These are all 4-hour charts, by the way. This retracement was nothing more than a move up into resistance, right? I mean, look at this. Even though it moves above these moving averages, it's nothing more than a move into resistance. You get a wide range bar down, find an entry. Look, so check this out. This is a 4-hour chart. You guys see this bottoming tail right here? Can everybody see the bottoming tail in the lower left that I'm pointing to? Right? I'm going to change this because this is a 4-hour chart. Let's say we see, right? We see this wide range bar down. We want to get on board because we couldn't play it. We couldn't play it from the 4-hour. So let's drill down to the hourly chart. We'll drill down to the hourly chart. Here's the hourly. You get a little base. You could have shorted the breakdown under this base. But you know what? Maybe this isn't the picture we want. So we drill down even more to the 15-minute chart. Right? And let me expand this chart a bit more. Look at this. Move down, retracement. This is a pristine sell setup. You sell it short under this 2-bar combination here. Drops beautifully, get a nice move lower. Here it's just basing. You short the breakdown. So you've got options. When one time frame doesn't provide the signal that you want, look at other time frames because they will set up. I knew by simply looking at that bottoming tail that there was going to be an opportunity to place a trade on these smaller time frames. So you have to understand that as well. And as you can see, this has been trending lower. I mean, you could have been trading this all day today. Right? You could have been trading this all day today, just playing the trend. Short this retracement, short this breakdown. You don't even have to get out, right? If you short it up here, you're still in this maybe. You short it again here, adding to your position. Beautiful drop. And like I said, that's a 15-minute. The hourly, short the breakdown. Just a gorgeous move lower. Now, you could have even played it from the 4-hour. You know, I mean, bottom line, you've got plenty of options here. As far as the U.S. or I'm sorry, Euro U.S. dollar here, look at what's going on. Just look at the range here. It comes up to resistance. You see, I don't need, like I said before, any kind of subjective tools. I don't need Bollinger Bands. I don't need, RSI. I don't need any, different, red light, green light type things. I just need an understanding of support and resistance. Here's an area where this has just been chopping around sideways. It's in an area of resistance where it's come up into. So look, you don't have any signal from the 4-hour chart, but if you drop down to the hourly chart, you get some topping tails up here. If you go down even further to the 15, you get a signal right up here where you could have played it short for a move back down to support, and then you get out. Right? That's just playing the range. Not really my preference, but it is an option that one has. The stop loss Z, depending on which pattern you were referring to, basically if you're shorting the breakdown, it'd be above the top of the base. If you were playing that PSS, the pristine sell setup that I mentioned, it would simply be above what would have become the pivot high. Right? So you're always putting your stop loss, if short, above resistance. If you're playing long, below support. The euro dollar reversing with higher lows. Well, you are getting some higher lows. That's true. If we look at the daily chart, though, it is in a sloppy, well, not really sloppy. It's in a downtrend. It's gotten a little sloppier over here, but this is still within a downtrend. So I'd be very cautious about looking to play it long for any kind of significant move to the upside, if that's what you're asking. My primary focus would still be on the short side. And, in fact, I wrote a little article on the multiple time frames of euro US dollar. If we look at the weekly, it's still in a downtrend, stabilizing a little bit here. Maybe it tries to retrace or just go sideways over the next, couple days, maybe week or so. But ultimately, this still looks like it's got some room to drop, down towards longer term, down towards 1.2, basically. All right. Another one actually that I mentioned, we have a group of traders that I talk to, and another one that I mentioned, let me pull it up here for you. I mentioned it yesterday, is pound Aussie dollar. I'm changing the bottom right-hand chart to pound Aussie dollar. And as far as what time period do you determine the stop? Based on the time frame that I'm entering the trade. So here's pound Aussie dollar. We have this move lower down into a support area where it did try to move up from, but it was really weak. There was very little movement to the upside off of this support level. So that tells me that traders are becoming more aggressive, those who are bearish, right? Supply is increasing. I see this base form. It breaks down. You get a green candle right here, followed by this very potent bearish reversal, engulfing candle. I said that this was the signal that it was going to move lower. And as you can see, that's exactly what it's done. You had a little bit of whip here. There was some news that came out there that created a little bit of whip. But, I mean, again, you get a beautiful move down before that, and it's still just following the downtrend lower. So beautiful opportunity there using nothing more than price, and in this case, some moving averages for overall guidance. But you don't need anything more than that. I could throw on Bollinger Bands, I could throw on RSI or whatever it may be, but at the end of the day, none of that matters. None of that matters because it's all based on price. That's where the signals come from, right? I mean, if I'm using some other kind of indicator, I might enter the trade, but where am I going to put my stop? Where am I entering based on the supply and demand relationship? I mean, let's say that you get a late entry. How do you know it's late, first of all? But like I said, where do you put your stop so that you're not getting caught in some kind of wiggle? You know what I mean? Though the indicators don't give you that kind of in-depth information. They don't help protect you. They say, okay, well, hey, this is overbought, this is oversold, or fib retracements, they say this is a good area to be looking to get on board. But where are you going to put your your stops and things of that nature? If you log in, Roxanne, you just have to log into whatever email and password you set up. If you log in through that, it'll be right there on your account. You can log in. It's for security purposes, we have it set up that way so that you can view it in a secured manner, and whenever you want, it'll be there, day or night. You'll have access. And if you need any help with it, you can contact our customer support for step by step through that as well. How do you find the best pairs to trade? Well, it's a lot of just kind of scanning. I look at about 20, 21, 26 different pairs throughout the day, and based on trend, based on some of the other things that we've talked about, the quality of the trend and how well the setups are shaping together, those are the things that I'm going to be looking for to determine which are the best ones to be trading. So for example, yeah, euro US dollar, it's moving, it's just chopping around though. It's in a sideways environment. Not going to be something I'm too focused on, especially when put up against, pound US dollar, which has been trending lower really well. This has put together some much easier, more fluid movement to make money from. This has just been much more, like I said, indecisive and volatile. You look at Aussie US dollar. Here it puts in a beautiful double bottom on the 4-hour time frame. It has a strong move up. We're looking to buy the next pullback. This first one fails. Right? This first one doesn't work out, but then you get this potent reversal following it, so you play it again here. Moves up, resistance right here. Now it's slowed down in upward momentum. Surprised? Shouldn't be. Right? It moved up into resistance. Now this is where it's going to start to struggle, which it has been. The link for the 4:30 webinar, Z, is through Pristine with Greg Capra, who is our president and CEO. He'll be looking at charts, reviewing different setups and the current market environment. So if you want to view that, it's through that link. All right. Does anybody have anything that they'd like to look at as far as Forex goes? As far as any pairs that you might have been looking at recently or anything of that nature? We can certainly take a look at that. Dollar, yeah, okay, let's take a look there. And Pristine has, like I said before, I'm changing this bottom right chart, by the way, to the 4-hour. We have a Forex education program which also has a prop component if one was interested in that, which I do teach. I lead that program. Right? But here's US dollar yen, and I mean this is on the 4-hour chart. This is beautiful. This is beautiful. As far as the time frame, I like the 4-hour chart. I also like the hourly chart. When it comes to Forex, the larger time frames are better because they put together some cleaner moves. So that's why I prefer the larger time frames with regard to Forex. You said all charts are the same. Why do you have different programs for the asset classes? Different programs, just for Forex versus equities, while the examples could be universal, it's nice to be able to have examples specific to what you want to learn. And that's why we just have the different courses. It's the same patterns, right? You're going to learn the same patterns regardless. But in the Forex program, for example, we're looking specifically at Forex. And, even that being said, there are certain nuances to Forex. A lot of traders do use fib retracement, so we may want to know where those levels are. But if we're going to use those levels, it's as an amplifier. It's just in addition to the pattern. Now, it looks like I'm going to run out of time, so I'm not going to be able to go through all of these guys that you put in. But if anybody wants to email me, I'd be more than happy to give you my analysis on them, or you can attend one of our webinars and we can look at it there as well. But I've only got about 60 seconds to go here. So as far as this example, beautiful uptrend, consolidation, buy the breakout, easy move up, buy this little base consolidation. I mean, look at this beautiful move up. So you buy the breakout, Here's a pullback, beautiful move up. Things are starting to get a little more indecisive here now, because if I showed you the daily, right, it just went screaming higher. So it needs to correct a bit, right, back to the 4-hour. It's starting to tighten up here. It looks like it wants to go higher. The trend is up. This attempt to move lower failed. All indications point higher. Daily is still bullish. I've got no reason to think it won't continue. Now, might it fail? Of course, no trade is guaranteed to work out, but based on all of this information, it suggests it will continue to move higher. All right, pound, Swiss franc. Again, this is a 4-hour chart. This one I wouldn't do too much with. I mean, it's range bound, but I really wouldn't be looking to do a whole heck of a lot with it. If anything, based on this time frame, the 4-hour chart, it is starting to look a little weak. If it breaks under this base, probably heads lower. All right. So, guys, that does it. I want to thank you for joining me, and also I want to thank you for Trading Pub putting this together. Do you trade when report? No, I don't trade around reports. Definitely not. Don't do that. Now, I may be in a position, and if I am, and I've got the entry far enough away, I'll sit through it, but I'm not going to trade right around a report, no. So if you guys have any other questions, like I said, you can email me, you can attend our webinars, whatever you need to do to get in contact with us. But thanks again, and hopefully I'll talk to you guys soon.